Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Today, we're taking a wrecking ball to Ulta Beauty's latest earnings report. Now, on the surface, the numbers look solid as a rock. But the market? The market reacted like it found a major crack in the foundation. We're here to find out why.
Yeah, that is the big question, isn't it? Management is popping the champagne over there, celebrating what looks like a huge win, but Wall Street is running for the exits like the building's on fire. This is the exact kind of paradox that can trap investors who aren't paying attention. You know, a pretty facade can hide a lot of structural problems. Our job today is to stress test this company, kick the tires, and see if it actually holds up.
Okay, let's dive right into this. Just look at the raw numbers on your screen. The street, all the so-called experts, they were looking for about $3.8 billion in revenue. Well, Ulta came in and delivered $3.9 billion. They wanted $7.93 in earnings per share. Ulta went and posted $8.01. I mean, this is a clean, undeniable beat on both the top and the bottom lines. In any normal world, this is a signal of pure strength, a solid steel beam in their financial structure. It's a textbook beat, and typically, investors would be all over this.
A steel beam? Are you kidding me? The market treated it like a lead balloon, a 4.28% drop on the day of the announcement. And some sources even clocked the initial after-hours drop at over 12%. I mean, that's not a slight wobble, that's a seismic shock. So the crucial question, the one we have to answer, is what did the market see that isn't in those headline numbers? What are they so afraid of? This is where we start digging.
Right. Before we get to all the fear and doubt, let's establish the facts. The bull case for Ulta, the argument for strength, is built on a foundation of powerful, undeniable growth. The market might be spooked, but the business itself is absolutely firing on all cylinders. So let's look at the full year picture to see the real strength we're talking about here. First, just wrap your head around the sheer scale of this operation. We are talking about a $12.4 billion revenue machine for the full fiscal year. This isn't some niche player, this is a dominant force in the beauty space. That kind of scale gives them tremendous leverage. They can dictate terms with suppliers, they can fund massive growth initiatives. It's a huge advantage. And this machine isn't just idling, it's accelerating. A 9.7% increase in sales for the full year. Now think about that. In an economic environment where consumers are supposedly tightening their belts and cutting back, that kind of top-line growth is a powerful testament to the resilience of their business model. It tells you people are still spending here, and more importantly, they're choosing to spend at Ulta. Now this slide shows what might just be Ulta's most powerful weapon, their moat. We're talking about nearly 47 million active loyalty members, a number that grew a healthy 5% last year alone. This is not just some customer list, folks. This is a direct line to a captive audience that competitors would absolutely kill for. It drives repeat business, and it gives them a massive data advantage to personalize offers and predict trends. They practically know what their customers want before they do. That is real power. And finally, let's look at the core health metric for any retailer, comparable sales growth, a positive 5.4% for the year. This is so important because it means it's not just new stores driving the numbers. Their existing, mature stores are getting more and more productive. They're selling more stuff to more people. And this isn't just smoke and mirrors. It's driven by both a 3.3% increase in the average ticket size and a 2% increase in total transactions. That combination is the absolute bedrock of a healthy retailer.
All right. That's a very shiny exterior you've built there. It looks great. But a strong frame doesn't mean a thing if the plumbing is leaking all over the place and the wiring is frayed and about to catch fire. The market isn't looking at what Ulta did last year. It's looking at the cost of that growth and what it means for the future. And this is where we find the stress fractures that caused that initial 12% nosedive.
This right here, this slide, brilliantly illustrates the entire problem. While you were focused on the revenue beat, the real story, the one Wall Street was paying attention to, is in the margins. Their operating margin completely collapsed from 14.8% down to 12.2% in the same quarter year over year. And just look at the EPS. It actually declined. It went from $8.46 down to $8.01. They sold more stuff, but made less profit per share. That's a huge flashing red flag that tells you the cost to achieve those sales is absolutely skyrocketing.
And here's the culprit. Just look at that SG&A line. For those of you who aren't familiar, SG&A stands for Selling, General, and Administrative Expenses. This is the money a company spends just to run its business. We're talking marketing, salaries, corporate overhead, the works. And Ulta's SG&A exploded.
It jumped a staggering 23% in the fourth quarter. It's like they're burning stacks of cash just to fuel that revenue engine. The question for any long-term investor has to be, is that sustainable? Or is this a sign that the cost of growth is spiraling completely out of control?
Spiraling out of control or strategically investing for the future? See, you call it a cost creep. Management calls it their Ulta Beauty Unleashed strategy. This isn't just random, chaotic spending. This is the heavy lifting required to build a global empire. You can't construct a skyscraper without spending a fortune on steel and concrete first. They're laying the groundwork, the foundation, for the next decade of growth, and that costs money. Let's break down where that 23% increase in SG&A actually went, because it's not what you think. It's not just inflated salaries and fancy new office chairs. It's the acquisition of Space NK, which gives them an immediate and major foothold in the UK and Ireland. It's funding their first company-owned stores down in Mexico and forging new partnerships in the Middle East. It's making critical investments in their supply chain and their IT systems to improve long-term efficiency. And yeah, of course, it's higher advertising and incentive pay to go out and capture that market share. You have to spend money to make money, and this right here is the blueprint for their global expansion. And you don't have to take my word for it. Management is saying it themselves. Just listen to what the CEO, Keisha Steelman, said on the earnings call. This quote signals a major shift in strategy. The heavy spending phase, the construction phase, is ending. Now they are preparing to harvest the rewards. They're telling the market directly. The pain from these investments is temporary, but the gains they're expecting are going to be permanent. A promise to reap the rewards is nice, but the market trades on hard numbers, not on pretty narratives. And when investors looked at the blueprint for next year, the fiscal 2026 guidance, they saw something that made them very nervous. This is the moment of truth. Does the plan actually hold up under scrutiny? Let's stress test the numbers they've laid out for us. Okay, let's put this guidance under the microscope. I want you to focus on the bottom line, the number that directly impacts shareholder value, earnings per share. The company is guiding for EPS between $28.05 and $28.55. The consensus from analysts, according to MarketBeat, was way down at $26.77. This is not a small beat. They are guiding significantly higher than Wall Street expected on profitability. This is the payoff from the investments we were just talking about. They're telling you the harvest is coming. But the market completely ignored that because their eyes went straight to the line right above it, comparable sales growth. They're guiding for just 2.5 to 3.5%. After just posting 5.4% for this year, that looks like a major deceleration. That's the number that spooked everyone. It signals that the core engine is slowing down, and no amount of financial engineering on the EPS line can hide that. It suggests that all that spending isn't buying them the same level of growth it used to. And that, my friend, is a very bad sign. So here we are. We've stress-tested the structure, we've examined the foundation, and we have definitely located the cracks. Now it's time for the verdict. How do you weigh a company that is simultaneously showing signs of incredible strength and, at the same time, very real potential weakness? This is where fortunes are made, or lost. Okay, the bull case is clear. This is a best-in-class retailer that is successfully gaining market share and expanding its global footprint. The investments they've made are painful in the short term, yes, but they're absolutely necessary to fortify their position for the long term. That positive EPS guidance for 2026, to me, suggests they have a handle on costs and are ready to turn the corner on profitability. For a long-term investor, this stock drop could be a golden buying opportunity to own a high-quality asset on the cheap. And the bear case is that the easy growth is over. The party's over. The cost of acquiring new customers and expanding into new markets is rising dramatically, and it is eating into their profits. That slowing comp sales guidance is a warning shot across the bow that the core U.S. business might be maturing. The market is telling you that the risk profile has fundamentally changed. You're no longer paying for a flawless growth story. You're paying for a riskier, more complex turnaround play on profitability. The structure might hold, but you're going to feel a lot more turbulence along the way. So ultimately, it comes down to this. You have to decide what kind of investor you are. Do you believe the architectural plan, that Ulta Beauty Unleashed strategy, is sound? And are you willing to ride out the construction phase to own what could become a global beauty powerhouse? Or do you see these margin pressures and slowing growth as deep foundational flaws that no amount of international expansion can possibly fix? Is this a company that has to spend more and more just to stand still? That's the question you need to answer for yourself. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.